What's going on, guys? This is Amish. Welcome back to another APJ trading video. Um, this is going to be a quick video on contracts and position sizing. So got a question from a buddy regarding a few things such as E-mini versus E-micro contracts. And I thought I'd also want to touch on contract rollovers, right? So depending on how familiar you are with futures trading, you'll know that there's the full size contract, which is known as the E-mini. And this symbol is simply NQ for the NASDAQ and ES for the S&P 500 futures. And then there is the E-mini micro, so micro E-mini on TradingView. The difference here mathematically is 10%, right? So a micro is 1/10 the size of a mini, and that applies for both ES and for NQ. So the micro contract for MNQ is known as MNQ, just an M in front. And the mini contract is simply NQ. Again, a micro is the 10th of the size of a mini. So 10 micros is equal to 1 mini, and vice versa. You could say 5 minis is equal to 50 micros. That being said, it works the same for the dollar amount, right? So one tick on the mini contract is $5 or $20 a point, 4 ticks in a point, right? So if we see these on the side here, these indications, so 2596, we'll do a round number, 2596.00 to 2597.00, that is a $20 difference on one E-mini contract, right? On the E-mini micro contract, for now, I'll just call them the micros, that same difference in price, so from 2596.00 to 2597.00, that is a $2 difference. So 50 cents a tick or $2 a point versus $5 a tick or $20 a point in the mini and the micro. Remember, everything is just divisible by 10. Same exact thing for ES. I trade NQ, but for ES traders, which I used to be one myself, it's the same idea. Yeah, and you can see, ES is much more binary in terms of its movement due to it being a smaller dollar value index, but there's still value to be traded here, right? So the E-mini contract on the left, the E-mini micro contract on the right, same thing. The micro contract is 10% the size of the mini. However, as some of you may know, ES trades at $50 a point instead of 20 on the mini contract, and $5 a point instead of $2 a point for the micro contract. So that being said, a tick on the mini contract is $12.50 when you're trading ES. When you're trading MES, right, the micro contract, it is $1.25 a tick. So same sort of example, 5615 even to 5616 even. That's a $5 difference. That's one whole point, 4 ticks, $5 difference on the micro contract. On the mini contract, that is a $50 difference for one whole point, or again, $12.50 for each tick, 4 ticks in a point. So that is the simple breakdown on, what's a mini, what's a micro. Gonna switch back to NQ real quick. Let me throw on MNQ on the right, and I'll put full-size mini contract on the left. As you see, they move identically. This is a live market, Sunday, July 7th, 2024, 10:30 p.m. Central Time. You'll see the charts look identical. If you didn't know which chart was which, you would think they are the same ticker. You'll see small differences, so I will highlight one here. So if you see this low on the micro chart, again, that is on the right, throw a big red arrow here. You see this low here is a little bit higher than the low on the mini chart here. Sometimes we will get these discrepancies between the two contracts. This is usually never, depending on the volatility, whether it's the open or, some external event such as news, it's never going to be much. It might be a point, it might be a few ticks, it might be maximum, just over a point. But here's a great example, right? So minis came down at, this is, my chart is in Eastern time, so 10:36 p.m. Eastern. The low on this candle is 20,596.50. At 10:41 p.m. Eastern, the low on this candle was, the low here was 25,996.50, right? So equal lows, exact same price here, as you can see, right? 25,996.50. Whereas on the micro contract here on the right, we see that same 10:36 p.m. Eastern candle make a low of 25,9575, and the 10:41 p.m. candle made a low of 25,9625. So half a point difference there, two ticks, but still a difference. That is about as much variation as you'll see between the two contracts. You're never going to see, for those ICT traders, you're never going to see SMT between the two contracts. And for those who don't know what that is, that's just different indices making highs and lows separately. You won't see that on minis and micros. The charts are pretty much going to be identical no matter what time frame you go to. So if I go to a daily chart, and this is just a paper trading account, so you'll see a bunch of arrows. These charts are pretty identical. Again, they're based on the same underlying index. Futures are based on the NASDAQ 100, both of them. It's just the contract variation. You don't have to worry about liquidity issues or being insolvent if you're trading the micros because you think you're trading a completely different asset. Yes, it's a different ticker, but it is, there's algorithms running all the time to keep both of these symbols very aligned. When one is upticking, you can pretty much be sure the other will be upticking, and vice versa. If one's going down, the other should be going down. That's that, right? Same asset, just different sizing. Now, if you're asking, what's the point of that? Why is there two tickers for the same symbol? Why is one 10% of the size of the other? This is simply risk control. The mini contract is a huge, huge, huge asset to trade. A lot of people forget this because they are, they're using margin, they're using leverage, which is very common now in futures. But, if I pull this over here to the right, I'm not sure if Trading View will show it, but one mini contract is, if you had no margin, this would be a few $100,000 to trade, right? Not just 20 grand. A micro contract is a tenth of that size, as I've said. So here we go. A micro contract, this is 41,000 worth of dollar value, right? We see on the right USD 41,000. A mini contract. Let me swap between these. USD. This is $411,000 to trade one mini. You see that? You see this number here. That's how big these contracts are, guys. These are not small financial derivatives. These are huge powerhouses. This is essentially the entire U.S. economy wrapped up into one index, and you're trading this. $20 a point or $2 a point might not seem like a lot, but don't forget you're using margin. That's why these are so volatile and so attractive to trade. That's the reason for the two contracts. Minis are 20 times the size here, hence the $20 a point on the NASDAQ, and on the S&P it's 50 times the size. So we just saw ES is 5,600 right now. Multiply that by 50. That is what we're working with if you had no margin. So 5,600 times 50, about 280 grand to cash trade one mini. Now every broker nowadays, like TradeAway, TradeStation, everyone has leverage. Everyone has margin available to their clients. Some brokers require $500 to trade a mini. Obviously that's very high risk. That's only on ES 10 points. That can go very wrong very quick. But these contracts are huge. That's what I'm trying to say here. There's a reason for micros. There's a reason for minis. Now, for everyone trading futures with prop firms, which I'll assume is most of you, let's say you have a $50,000 account. You should be fine trading a mini, depending on what you're risking. For example, with Apex, you have $2,500 worth of drawdown. So if you're trading one mini, let's say you have a 10-point stop, right? Which this is a daily chart, so these increments are huge. But if you have a 10-point stop on a mini contract, that is going to be $200 for one contract, right? That's a fraction of your total account risk, right? That's less than half a percentage if you base it on 50 grand, right? Because 1% would be $500, half a percent is $250 on a $50,000 account. So you could get away with trading one mini, assuming you have a proven system. But if you're trading a smaller account where you don't like to risk as much, let's say you're holding for a bigger move, you need a wider stop, you're not scalping, you might be better off trading micros. I have a friend who trades micros exclusively. I think he's doing 6 micros on a $50,000 account, and that's great. He can capture 100 points easily. Shout out to you, Connor. But don't get caught up in saying oh, I'm trading a $50,000 account, I need to trade minis. No, you can trade micros. You can also add to positions, and you can scale out a lot more easily when trading micros as compared to minis, right? If you have a mini, odds are you're not going to be trading 2, 4, 5 minis at a time. Depending on your account size, it's probably not a great idea to do that, right? Whereas with micros, you can easily trade 5 micros, 10 micros, and be just fine, because again, 10 micros is one mini. Now, where does that benefit you? Let's say you have multiple price targets. So let's say I'm short. This could be my first price target. This could be my second down here. I target lows, so that's why I'm pointing out all these lows. Let's say I had 3 micros. I was short 3 micros. I could sell, one here, or I could buy to cover one here, buy one here, and buy one here, right? I can scale out of my position. Whereas with minis, if I only had one mini, I need to pick where I want to exit my position at. To make it a little bit more comparable, we'll just use these 2 lows, and let's say I had one mini and I had 10 micros. I could sell 5 micros at one target, or I could exit out of 5 at one target and exit out of another 5 at a further target, right? Whereas with a mini, for the same exact dollar value, 10 micros versus one mini, same position size, just different ways of breaking it down, I have to get out at one price. I have to buy to cover at one price. I can't hold a runner. I can't scale out in the manner I would be able to with a micro contract. That is a huge difference. That's a benefit for everyone who's holding for a bigger range. Like I said, if you're scalping, you might prefer minis. You're going to pay less in commissions trading minis. With Apex and TradeAvate, it's $3.10 round trip for one mini, and I think micros are just over $1 each. So if I'm trading one mini with Apex, I'm going to be paying $3.10 round trip. If I'm trading 10 micros, the equivalent of one mini, I'm going to be paying about $10. Unless my math isn't exactly right. I know for a fact it's $3.10 round trip per mini. I think it's like $1.04 per micro. So definitely more in commissions for a micro, but again, you're probably going to be scaling out. You're probably holding your position for a bit longer than you would be with a mini. But those are the differences, guys. If you kind of skipped ahead, a micro is the 10th of the size of a mini. That is the only difference. They move the same algorithms control them, and both are extremely liquid. You never really have to worry about about not being able to exit the market when you want to on either contract, or having wide spreads. If the market's open, you'll be okay. The market's liquid. This is a big market. So that's minis versus micros. One thing I want to touch on before I wrap this up is contract rollovers. So I'll go back to just one chart here. With futures, you have 4 contracts a year. I believe H is the March contract. So if you see on the right here, you see NQU 2024. On TradeAvate, it's simply NQ, but when you actually break down the symbol, they'll show you a letter in between the letters NQ and between the year 2024. That just means the which out of those 4 contracts this is. So U is September, I believe H is March, Z is June, and I forget what December is. But there's 4 letters you might see in between NQ and 2024. That just differentiates what month contract you're trading. So if I typed in NQH 2024, this would pull up the March 2024 contract. This contract has expired. It's no longer tradable, and that's why you see it just kind of dead here. If you're using TradeAvate, as long as you type in NQ, it'll pull up the latest contract. Now, when you want to switch over is when the forward month, so right now we are in the September contract because June has already came and went. And like I said, these are quarterly contracts, so there's 4 a year, March, June, September, and December. Towards the end of the month, which contract you're trading, so the June contract came up at the end of March, right? When the March contract expired. At the end of June, that contract became illiquid, right? And open interest and volume significantly dropped. We flip over to the next contract. So this is the U September contract. We flip over to that kind of mid-June to late June. That's when you want to roll over. I doubt you guys are swing trading positions. If you are, you're going to roll them over. Otherwise, you're just going to switch the ticker symbol you're trading. In TradeAvate, they'll give you a notice, and you can check the open interest and all that good stuff there. But that is a little breakdown on contracts, position sizing, minis, micros, and a brief touch on seasonal contracts. I hope this video has been informative to some people out there. If you enjoyed it, please leave a like, subscribe, and share this video. If you want to get into futures trading, I highly recommend Apex Trader Funding. I've been trading prop firms for almost 2 years now. They're by far the best. You can trade up to 20 accounts, multiply your profits by up to 20. Very low barrier to entry, and they're always running sales, guys. 70, 80, 90% off. Right now, I believe it's 80% off. I'm sure there'll be a 90% off soon. Use my code, link in the description. Save that money. Get started trading. And until next time, train and trade well, as S&P Capital says.